as she said, I like data. One of my clients that passed away a couple of years ago was a retired doctor, and he had in his office a sign that said, "In God we trust, all others bring data." And so that's sort of the way I look at a lot of things. But we're going to get into some data, but before we do that, what we wanted to do is start it off sort of with a little bit lighter note. And so we're going to start it off with a video. Okay.
What? That's it?
That's it. Yeah. Back on? Okay. So hopefully that made you smile or laugh, because I think especially as you travel around after 9/11, things, it's not quite as easy and fun as that. But we're going to talk a little bit, so we're going to sort of divide this into two groups of one, we're going to talk about last year, what happened, why, what we saw, and then we're going to talk about this year and what we're seeing and how we're positioning things. And this is sort of appropriate for what the fourth quarter of last year seemed like, sort of a roller coaster. So where are we today? So as we look at last year, I found this chart that I really like. It quickly tells you what happened. This is 70 Morningstar fund categories. So it goes from bonds all the way to emerging market stocks and everything else. Now, these are not individual funds, these are fund categories. There's 70 of them, and what you see here is you see right over here a little tiny part of green. Red, if you haven't figured it out, that's bad. And there's lots of it and big numbers here. The green, little tiny numbers. So there wasn't a lot of places to hide last year. It was one of the few years. Normally you'll have some things that even when the markets sell off, some things will do well. Last year, not many. Now this is a sort of a quilt, and if you can recognize the patterns, you get an extra dessert. Not really. But what this is, and you don't need to really see what it is as far as what the numbers are, but if you look, each one of these is a different asset class, from real estate to emerging market stocks. And what you see is there's no real rhyme or reason. Some are up, some are down one year versus the other. Some go from the best to the worst from one year to the next. But what I wanted to show is this goes all the way back to 1999, 20 years. And if you look at the top ones up here that did well, that's 27, 13, 8, 22, 55, 37, 34, 42. Usually what does well does really well. What did well here? That's cash, 1.8%. Rare for that to occur. I mean, even if you go back to 2008, you were looking at over 5% in fixed income. So this just sort of sets, and all of you guys have felt what it feels like when that occurs. You also probably looked and said, oh man, it was a roller coaster, up and down, up and down. Well, really, and what this shows that's the dark blue is days where there was 1% up or down. The lighter blue, 2% up or down, and as Linda would say, that's periwinkle. -3 or +3, all the way up to plus or minus 5%. This was 2018. That's the average over the last 50 years. So even though last year seemed like a very volatile time, over the entire year, it wasn't. It was actually below average. The problem is that when you looked at February and then you looked at the fourth quarter, that's when nearly all of that came. So it came in a compressed time frame. In fact, the third quarter of last year was one of the least volatile times we've ever had. And if you look at 2017, you're looking here and saying, hey, there wasn't hardly any volatility. And one of the ways when you look at how people think about something, one of the things they talk about is the recency bias. And all that means is what I've experienced most recently, I think that's the normal. And so then if something goes back to average and you were, in this case, in 2017, very much below average, then you come back not even to average, you think, oh, this is tremendous volatility, when in fact it wasn't. But saying all of that still didn't make it feel any better. And that may have been how a lot of investors felt. I know some days when the market's down, everybody feels like that. Some of you, when we've had reviews, we've talked about some things of Daniel Kahneman. He won the Nobel Prize in economics, and he's not an economist. He's a psychologist. And one of the things he won it for was showing that people make uneconomic financial decisions. And he showed statistically that basically the pain of loss is twice as great as the joy of a gain. And if you start thinking about it, think about a day where the market was down 800 points. And then the next 2 days it comes back 400 points a day. Did you feel were your emotions about the same over those 2 days that it regained it versus the 800 points when it lost? Most people it's not. I mean, it's a gut check when it drops like that, and yet when it rebounds dollar-wise, you can look and you can say, well, it was the same dollars. Or the other thing is, if you think a little bit about when you were first starting to invest and you had a little bit of money and you had $50,000 and the market sells off 4 or 5% and you're down $2,000. How does that feel versus it's down 5% and you've got $1 million and now you're down $50,000 in a day? Same percentage, but it makes a difference of how you feel about it. That when you look at this, it does impact both how you feel. It also impacts the markets, because the markets are made up of all the investors. And I will tell you, from being back in Wall Street where people were managing billions and billions of dollars, they feel the same thing. One of the reasons we like trying to use models is it tends to mitigate some of that. And this is what we've talked about a lot. Emotion is the enemy to good investing. And what I mean by that, it really means that at the top of markets, and I'll show you right here, the top of markets, people want to invest. It's exactly opposite than retail. I mean, if Nordstrom sends you out a thing and says, we've just increased our prices by 10%, you don't want to go buy. But if stocks just went up 25, you want to get in. It's the fear of missing out. And so this chart is an interesting chart. What it shows is these, the green here is above the line. This is zero. And that's flows of money, billions of dollars basically going into stocks. And the red line is the stock market. So what do you see? When the market goes up, a lot of money goes in. When the market, goes down, then money starts coming out. When it hits all-time highs, tons of money goes in. When it goes down, it's already gone down here, and then everybody pulls money out. So that's what we try to look at. Do I have enough in lower risk stuff if I'm pulling money out or going to be pulling money out in the next few years, so that I don't have to sell out of stocks when that occurs? So that's a piece of what we wanted to show a little bit of what happened last year. Now, when you look at what caused that, a lot of that, one of the big things was the trade. And you say, okay, so what about trade? Why, especially with China? You say, why China trade has caused such concern? Well, let me show you. And this, I'll just outline this and then we'll run it, because this starts back in 1962 and shows basically the GDP of countries. And back in 1962, we had $575 billion was our GDP. Today, we're at nearly $20 trillion. So you can see how far it's gone. But what I was wanting to show here, see, even if you look at China back then, it was 49 billion. So it was basically nearly 12 times, or we were 12 times the size of China. Even the UK, I mean, there we were 8 times the size of the UK during that time frame. But let's run this. In fact, yeah. So now it's going to show you over time, how much the GDPs are growing and what position everybody's in. So if we stop at 1972, if you remember in 1972, that's when Nixon and Kissinger went to China and we started actually having diplomatic relations again with China. At that point, if you look here, okay, so now we're at 1.2 trillion, and Japan and Germany are 275 to 300 billion. So they're catching up, but they're still a fraction of where we are. And China, basically 1/12 of our size. It's behind Italy and right on top of Canada. So think about this. 1972, the GDP of China was what Canada's GDP was, and yet they had, I don't know, 10, 20 times the number of people. So let's fast forward. You just watch it here. And we'll stop in 1982, 10 years later. So 1982, now we're at nearly 3.3 trillion, but all of a sudden Japan here is, a third of our GDP. And if you remember in the 80s, that's when Japan really started coming on strong. Everybody, if you looked at Forbes or any of those, what you would see, oh, we want to be like Japan. They've got it all figured out. And what you see here is you don't see China anywhere here. You got Canada at 300 billion, about a tenth of ours. But even then, and China really started to open up their economy to capitalism in the late 70s. And they just did it in a very small way, but they start taking off here. So let's look at another 10 years here. And now you're seeing China starting to move up. And you see Japan really moving up. At one point, they get to be 60% of our GDP. 89 to 90, that was when they bought Pebble Beach. They were buying real estate in New York, and everybody says they've got it all figured out. The problem is that about that time, they started having a banking crisis, similar to what we had with the savings and loan crisis. But the difference is they didn't shut their banks down. The culture over there is, oh, we don't want to play hardball. And so they let their banks just sort of limp along. They would say, you don't write off the loan, just loan them the interest to pay you the interest back. And it was a disaster for them. I mean, it really has been. But what you're seeing is you're starting to see, here's China, but they're still way below us. So let's go another 10 years. And that's where you get Japan nearly to 60% of our GDP, with less than half of our population. But you look and you say, who's moving up? So 2002, now we're 10, nearly 11 trillion, and now they're 1.4 trillion, behind France, UK, Germany, and Japan. The problem that we have is, at that point, we're growing at 3%, they're growing at 10. Well, it doesn't take many years of that compounded growth to catch up in a hurry. So let's run it from there. You start seeing them moving up, passing Germany, and ultimately passing Japan. And we're still growing. We're just growing a lot slower than they are. And I think this stops in 2017. Yeah. Okay. So here, why is it important on the trade? Go back, Linda. You can just move it out to nearly the end.
Sorry, you talk. Okay.
The reason it's important now is they're 60% of our GDP. And since they're growing at 6% and we're growing at less than 3%, it's only a matter of time before they're going to exceed us from a GDP standpoint, probably within the next 7 or 8 years. And in fact, if you look at it on a purchasing power parity basis, and because we're looking at all this in US dollars, But if you look at what their GDP is and what it can buy in goods and services there, it's actually greater than our GDP because things are so expensive here. So a dollar of GDP over there will buy a lot more goods and services than they will here. They will probably never get, and the real important piece here is per capita GDP. Because if you're in Belgium, you don't care that you're a small economy. You care that you have a good income and a good standard of living. They don't look, oh, this is terrible, we're below France and Germany. They look and say, what's our income? So China's never going to catch us from that standpoint because they are in a position of, with the one-child policy for so many years, they're going to hit a place where they're going to decline in population just as Japan is. So anyway, let's go, can you go to the next one? Yeah, okay. So if you look at, and here, Fred is not our uncle. Fred is the Federal Reserve Economic Database. And if you ever have insomnia and want to go someplace to go to sleep, that's it. It's 15,000 charts. But anything that can be counted, they've counted. And what this shows is down is bad, up is good in this case, because it's our negative trade balance, and so it's going down here. So what you see is it got worse and worse and worse in the 90s and 2000. Then it got a lot better in the recession of 2008. Why? Because everybody stopped buying stuff, so we weren't importing. But since then, it's deteriorated. It's sort of gone sideways. But I'll point out right here, the last year it's gotten worse. It's gotten worse because of the tariffs. And you say, well, why is that? I thought the tariffs were put in place so it'd get better. Well, if you tell me that what I buy from you is going to cost 20% more in 60 days or 90 days, what do? I go and buy a bunch of it. So if you go to Costco and buy a bunch of something for the next year, it doesn't mean 6 months from now that you don't have that demand. You're still using it, but you brought that demand that was forward to today. And that's what we're seeing here. Now, look, if you look and focus on some of this, and I put this here because if you focus on this area up here, all the dots look like they're white. But in the peripheral vision, if you look at some of the other ones, they'll look like they're black. But then if you move down here, those that were black become white. Why do I say that? Because everybody will look at the data just like this, and there's half of the people that are going to say, oh, whoops, this is terrible. And half the people are saying, well, of course that's good. That means the tariffs are working, everybody's buying, and it's going to improve later on. And that's what makes a market. People looking at the same thing, they're seeing it, but they see it in different ways. And we'll bring this up a couple of other times. The other is at the end of the year, the shutdown and the threat of the shutdown hurt the markets. Why? Because people don't like uncertainty. Now, we've got a reprieve for a couple of weeks, but I suspect we're going to have the same problem here in a couple of weeks. That has sort of now gone away, and you've seen the market liked it, and the market's gone up from there. The other is the Federal Reserve, and that's going to be a longer-term issue. And today the FOMC meeting came out much more relaxed and, oh, we're not going to raise rates a lot. Whether that's true or not, or whether they realized last in December when they raised rates, the market didn't like that, especially when they basically said, look, we're on a plan, here it is, too bad. If you don't like it, don't invest. And the market tanked after that. And so now I think they're sort of saying, hey, we need to pay attention to this. I'm not sure it's changed much, but the language definitely did. In the past, in December, they said a gradual rise in rates. They took that language out. They said we're going to, in fact, they didn't say a rise in rates. They just said we will look based on the data to make adjustments in the federal funds rate, which people, if you're optimistic, you read into that, well, that means that they could lower the rates. And why is that a big deal? Well, you look here, and this is going back all the way to the 1950s, and this is the Fed funds rate. And we went for 6-7 years with it at zero effectively, and so now we're up to 2.5%. Now, most of you would look at this chart and say, so why is somebody concerned? It's a little dot there, and most of the time it's been dramatically higher. I mean, some of you will remember back in the early 80s when the Fed funds rate was at 16.5 and the prime rate was at 21 and mortgages were at 16. I mean, people complaining that mortgage rates have gone from 4 to 4.5. I look and say, you're out of your mind. I mean, I would have killed for that for most of my adult life. But that's the recency bias. I mean, if you had 3.5 to 4% and it goes to 4.5, say, oh, it's gone up dramatically. But this is what people are concerned about. Is that the start of something bigger? And it impacts, if mortgage rates go to 4.5 or 5 or 5.5, people will look and say, you don't buy a whole lot of stuff. Corporations, they borrow trillions of dollars. They have to pay the interest. If interest rates go up, they make less money. Or they don't, go out and borrow more money, and so therefore they don't invest as much in plant and equipment. So this is one of the concerns that we're going to continue to have because rates will probably go up. The other is federal debt. This is, the Treasury borrowing money. And if you look at it, what you see here is after the recession, the trajectory got a lot steeper. And we've gone from 10 trillion to over $21 trillion in the last 9 years now. And ultimately, as interest rates go up, and I will tell you, up until about right here, we had nearly doubled the amount of money that we had borrowed, and the actual interest payments that the Treasury was making were actually less than they were back here when we only owed 10 trillion, because interest rates had gone down so much. Now, a lot of this is not going to impact because you've got a lot of this bonds and stuff that the Treasury has borrowed that they're a mortgage. It's 20-year, 30-year, 10-year money, and once they set that, they're going to pay that. So rates go up, that is fixed. It's just like you having a fixed rate mortgage. Mortgage rates go up, doesn't impact you from the standpoint of you've got a mortgage and you're going to continue to pay it. But that's another concern, longer term, of how do we deal with that. And in fact, Chairman Powell today, somebody asked him, well, what about the national debt? Aren't you concerned about that? And he's politically correct. He said, we don't really get into the long-term stuff, but he says, but it's clear that the fiscal policy has to change. Basically him saying, you got to rein it in without saying, the Congress and the President, are on the wrong track here. But that's what he said, and it's easy to see. This is the deficit, and this is probably what he's concerned more about. This goes back all the way to the 1970s. What you see, these lines, these shaded lines, that's when there's a recession. And so here, when you see a recession, usually, and this is the same way, down is bad, up is good, because this is trillions of dollars of deficit. So when you get to a recession, the deficit goes up. Why? More people are unemployed, more people are on food stamps, less people are making money and paying taxes, corporations' profits comes down. So it always works, and then it should bounce back, and it does. It goes down here, it bounces back up, goes down after that recession, bounces back. The problem is when you're at full employment like we are right now, I mean, nobody can look and say, hey, employment's really bad. It's not. It's about as good as it gets, and I'll show you in a little bit. But when it gets really good, like the end of the 90s, what should occur is we should have no deficit and a slight surplus. The problem is we went down, and that's, in a really bad recession like we had in 2008 and 9, it's not surprising we went to a $1.4 trillion deficit. And then we slowly, came back, and then we started up a bunch. 3 years ago, we got that down to about $400 billion. Unemployment, GDP, unemployment's gone down since then, GDP's gone up since then, but what's happened to the deficit? We're going to run a $1 trillion deficit this year. We're going the wrong way from that standpoint, and that is not sustainable. Now, when you look at this picture, what do you see? How old is the woman in it?
25.
25? Any other takers?
Depends on which one you're
Depends
looking
which
at.
way you're looking
Okay,
at.
so some of you have probably seen this before, and it's interesting because I first saw this, Stephen R. Covey, the guy that wrote 7 Habits of Highly Effective People. He did this in a seminar where you had a notebook, And one of the things that he had, and half the group had a notebook, and the couple of pages before, on one it showed young people, and on the others it showed really old people. And then he makes the statement, says, how old is the woman? And some people say, oh, she looks like she's 80 or 90 years old. And the other people say, are you crazy? She looks like she can't be more than 25. Because you're looking at the same thing, and for those that haven't seen it, the old woman, here's her chin and her mouth and her nose, and when you're looking, there's her eyes. But if you're looking at the young woman, she's got this beautiful hat on, and there's the profile of her face with her chin and her nose and her eyes. And if you haven't ever seen it, the first time you see it, you'll normally reflect on one part of it. And in fact, I've seen it dozens of times. And when I first pulled it up, I looked and I saw the old woman. So maybe the first time I saw it was like 15 years ago. So I'm 15 years older, so I'm seeing the old woman versus the young woman. But same thing, different. Yeah, okay. You're always going to be younger than me, Linda. But same thing. Everybody will look at this data and they will look and say, well, I think the market's clearly undervalued. We ought to be buying. And others people will say, oh, it's clearly overvalued. They're looking at the same data. Ultimately, one will be right and one will be wrong. But the reality is that's what makes markets. So, questions on last year, what causes, effects, things that you were concerned about, and we'll get in the next part of this will be basically going and looking and saying, here's what we see going forward, and what we're doing and where we see opportunities and where we see potential risks. So, any questions? Yes.
When they talk about the deficit, they sometimes want to say that it's not a problem because it's a percentage of GDP. Mm-hmm. Should we buy into that, or is that a false promise?
No, that is a good piece, but I will. The interesting part here is so we're going to get to $1 trillion to a little bit more than $1 trillion. So on a nearly $20 trillion GDP, you're looking at basically 5%. I don't know if you followed, but in Europe, the last 2 or 3 months, Italy got into a lot of hot water because they proposed a budget that had a deficit that was, if I remember right, a little more than 3% of GDP. And the EU rules are you can't do that. So yes, to look at it on a percent of GDP is probably a better way to look at it, but even there, it's not sustainable. Okay. Yes, Wayne.
So Dave, back to your last slide. Is the deficit...
This one? Okay, what do you want to know? Did you see? Okay.
Now, is it a revenue issue or a spending issue, in the current period? I realize we have, a lot more income because of, the health of the economy, but we've had tax cuts.
Yep.
But we also have spending, that...
Well, one of the big problems that they have is that, most companies, most individuals, you look and you say, here, I'm budgeting X dollars for this. And, you have X dollars, and when it's gone, it's gone. The federal government, because most of these laws that are eating up the dollars, they're not, oh, we're budgeting X dollars for Medicare or X dollars for Social Security or X dollars for any of those food stamps. By law, whatever people submit, we've got to pay. And when you look at that, the amount of discretionary spending that is not already mandated by law that you'd have to go back and change, it's a tiny percent. I mean, that's the problem. But when you look, when you look here in this room, we've got people that are retired, people that are close to retirement. And as that occurs, and we get more and more people that are on Medicare, that are on Social Security, that's going to increase that deficit. But I think it's both on both sides. One of the things, when I look at the tax cut was probably too big. Was it? Did we need a tax cut? Yes. But if you look just at the corporate side went from 35% to 21%. I mean, it nearly got cut in half. And if you look, and the argument was, look, we've got the highest corporate tax rate in the world, so companies are going to go overseas where they're not taxed as much. Well, the problem with that is if you look at, and it's a very valid thing, we did have the highest. But if you look at most developed countries, I mean, they're in the 25 to 27% range. I mean, there's a few like Ireland. I mean, but if you're Ireland and you're tiny, you have a 16% tax rate and you hope everybody comes. And they do, and usually have a building that's their headquarters and nobody working there, because that's just for tax purposes. But most of them were 25 to 27. We moved all the way to 21. I think you're going to have to move it back up. Not to 35, but to 25, 28, something like that. On the corporate side, and this is what, this is where I just, it makes me really mad when I think about Congress. So a year ago and a year ago and a month, when they were hammering out exactly what the tax cuts were going to be and everything, the Senate had a version and the House had a version, and then they get together in committee, conference committee, and they work out a compromise there. And you say, okay, yeah, that makes perfect sense. And then they take it back, and when they take it back, you don't say, no, I don't like that. Let's vote on something close to it. You either, it's up or down. You either vote for that or you don't. And the idea is that in the conference committee, you work out the details and you have trust in there. So the highest tax bracket, and I'll have to see if I can remember, the highest tax bracket for, I think it's the Senate bill, was like 36.9. They didn't change it. Is 36 or 39.6. The Senate was, I think, 39. So they go to conference, and voila, come out and compromise on 37. You look, say, 39 and 0.6 and 39, and you compromise. All of the other ones where they were off, the compromise was somewhere in between. It's not hard to figure out, why they did that. I mean, if I want to raise $3 million for my Senate run, I go to the Hamptons on a weekend, and the hedge fund guys and the billionaires will raise that money for me. And that's the problem with what happens in Congress. I mean, there are so many vested interests that are not really looking out for the average person. But I do think you're going to have to raise rates probably on some, either, and part of it like on Social Security. It may be that, like right now it's capped at, what, 128 I think this year, 128, 129. They may have to take that off. They may have to say, on all your earned income, you have to pay Social Security because it's capped right now. Or they passed on investment income or those types of things. They're going to look for money, and unfortunately, they're going to look for money from people like you. I mean, that's where they're going to look for it. But I think it's on both sides, Wayne. I don't think it's a thing of, oh, we just got to cut spending, because the problem, if I look, say, let's cut back on Social Security. I mean, okay, well, I don't need a re-election committee because, I'm not going to get re-elected. So they're never, I mean, that's like the third rail. That gets you electrocuted and you're gone. But I do think they'll do just like they did for all of us. And I can't remember how old I was when they changed it and said, oh, you don't retire at 65, David, yours is going to be 66 in 8 or 10 months. And I can remember at the time, I'm probably never going to be there anyway. So I didn't care. And so I didn't vote anybody out that voted for that. So they will probably make a change so that it's not, retirement at 67. It'll be retirement at 68 or 69 or 70, something like that. So I suspect, but it will be for people that are 35 right now. Because if you're 55 and you say, hey, I'm retiring in the next few years, I'm going to be mad as hell if that occurs. So so they're not going to do that. They're going to do people that are not going to vote them out. But I think you're going to have to do it on across the board. Medicare is a disaster as far as the cost of it. We're paying 17-18% of our GDP. In fact, I saw a stat the other day said if our healthcare system in the U.S. was a country, it would have the 5th largest GDP in the world. I mean, that's stupid. I mean, you look at Germany, you look at Switzerland, they're paying 8 to 11% of GDP on healthcare, and we're doing 18%. It's going to be hard to compete long term. So, and I think regardless of who gets elected in 2 years, both in the House, the Senate, and the presidency, they're going to have to raise taxes because of this very issue. How they do it and what taxes they put in place will change depending upon who's there, but they're going to have to raise taxes. I mean, it's unsustainable. Yes.
Raise taxes on who?
Yes, that's the answer. I mean, they will probably.
There's, I mean, 75,000 families are responsible for 90% of the wealth in this country.
Mm-hmm. And you will see more, but that goes back to what I was talking about of the conference committee on taxes. Yeah, those 75,000 families, they're the ones that went from 39.6 to 37. When you would say that that wasn't in the cards. Well, it was at the end of the day. But it's all political because nobody had to say, well, I voted, I was the one that proposed it go down to 37. And you do it in conference committee and nobody really votes. So I think there'll be, and it may be as easy as we're going to raise taxes a little bit here, and like I could see on Social Security, where they look and they say, okay, maybe you don't get all your Social Security. I mean, it started out that Social Security was completely tax-free. The idea was, I paid it in over time, I'm getting my money back. And then along comes, the different wars that we fought over the last 50 years, and okay, let's make it, partially. And now at, most of your levels, it's going to be 85% is going to be taxable. But I could see them come to the point of saying, no, let's just make it so that you only get 85%. I mean, I could clearly see you could end up in that scenario. Anything else, or we'll go on? Okay. So the outlook for this year, if we're looking at all the data, and when you look at the news that comes out. Bad news always sells. I mean, nobody says things are hunky-dory, let's just keep going on. That nobody gets good ratings from that. So you're always going to hear the bad part. In fact, it was what was it? Housing starts today. I see a headline that says, housing plunges. And it's what was it? New home sales or new permits was down 2.2%. That doesn't sound like a plunge. I mean, but it got me to read the article. I mean, I looked at it, and so it worked. But what we're seeing, like I showed you before, when you look at a lot of the data, it looks pretty good. So if you look here, job openings, and this is, so here, up is good, down is bad. These are job openings. There's a report that comes out, they call it the JOLTS report, the Job Opening and Labor Turnover Survey. Basically says how many job openings are there. Well, when you get into recession, they plummet because nobody's hiring. They're all firing. And so what you've seen is a steady increase, and now we're at a level where we have more job openings around the U.S. than we have people unemployed. And I don't ever remember hearing that in my adult life. Now you say, well, so why is anybody unemployed? Well, there's always a mismatch. You're an engineer, I need somebody who runs a backhoe. You're in Phoenix, I need somebody in Midland, Odessa, Texas. In fact, one of our clients that's in the oil business up in Utah, he was telling me that in Midland, Odessa, and I grew up about 78, probably 100 miles from Midland, Odessa, and great football teams there, not much else except oil and natural gas. And there's probably not, between those two cities, 150,000 people. He said there are 6,000 unfilled jobs in the oil field that pay over $100,000 a year in Midland, Odessa right now. I mean, so you look at the economy, it is booming there, and all over the U.S. I mean, when I talk to small businesses, large businesses, and say, what's your big issue? They say, finding qualified people. I mean, across the board. So that's a good number, as it's at some all-time highs. We look at that, and this is the unemployment rate. So low, down is good, up is bad. This goes all the way back to 1950. So at the recession, we went there from 4.5% all the way up to 10%. I mean, it was terrible. All the way back, you have to go back into the early 80s when interest rates went to 21%. It's come all the way down to below 4%. And when you look at it and say, when was the last time? Before the 2008, it was higher than that. 2000, it was higher than that. You have to go back to basically 1969 before you get to the unemployment rate we're at right now. So things are good from that standpoint. If you look here, though, you look and you say, what has that done? Well, anytime you go into recession, and this is median income, household income, and it's real, meaning it's adjusted for inflation. And so what you saw is it took a big hit. In fact, it went down to where we were back 20 years before. But it's climbed up, and now we're at all-time highs. In fact, the last monthly number was that year-over-year average earnings were up 3.2%. So middle class and the average worker is actually now starting to benefit from the recovery. For a long time they haven't. Those that were in upper income levels were continuing to make more money, but those that were in the middle class were not. And this is actually a very good number from that standpoint. More people, more income, and then what do? Well, this is personal consumption, spending. You make more money, you're employed, you spend more. And this is about 70% of our economy. In contrast to China, China only spends, their GDP is only about 40% consumer. And that's one of the things that they're going to have to change as they get out of just being exporters to becoming consumers also. So you look at that and you say, that's really good. And that translates into very good GDP numbers. So you're looking here at the fall from the Great Recession, and we recovered. And we recovered quite nicely. This last year, when the final numbers come out, is probably going to be somewhere in the neighborhood of 3%, 3.2% growth. First time in 10 years that we'll have had 3%. Let me tell you, part of that is not real from the standpoint where I talked about people buying stuff in anticipation of the tariffs. Probably 1% of that is from that. So one of the things that you'll hear in the next probably quarter or two, you'll see a GDP print of 1.5, someplace less than 2, and people are going to say, oh yeah, we're going into recession, it's slowed down dramatically. The reality is we're not going to be able to grow much more than about 2%. Why? Because our workforce is only growing about 0.5% a year. Historically, the 3% that we've had in growth over the last 40, 50 years, half of that has been workforce growth of 1.5%, half of it being productivity gains. We're still getting some productivity gains, but we're not getting growth. And you can't just go out and manufacture a lot of 22-year-old college students. I mean, it takes time. And that's China's problem that they're going to have. This is a number, and what this is this is a household debt service. You'll have heard, and I've seen numerous articles about it, of saying, oh, the household debt is way too high, people are going to not be able to spend and stuff. Well, let me tell you, I've looked at this for years, and the difference of this, if I have a mortgage that's $200,000, what happens is, it's $200,000, but if it's at 6%, then I'm paying $1,250 a month. If it's at 4%, I'm paying $950. That's what they're looking at. So when I look at this and I say, look, it came down from 2008, and this mainly came down because interest rates went down, and everybody and their dog, refinanced at very low rates. And so when you look at that, most of that's not going to go up, even if interest rates go up, simply because most people have a 15 or a 30-year mortgage, and it's not going to change. So I look at this, same way with corporations. People will say, corporations have so much debt. They do, but most of it's at very low interest rates, and so for the foreseeable future, when it comes due and they have to refinance at higher rates, that'll be a different story. But right now, they're still doing pretty well. Now, market outlook, the bull and the bear. How are we doing for time? Okay, we're still, okay. This is the PE ratio of the S&P 500 going all the way back to 19. Earnings of the S&P 500 companies were up over 20% last year, and yet the market lost money. So if earnings go up by 20% and the market goes down, then all of a sudden you're 20% cheaper than you were a year ago. Now, I'm not saying that this is cheap, because you're looking here and that's a PE. We were at 22, 23 PE last year, and now we're down in the 17, 18. And there's lots of people who say, oh yeah, but the forecast is even higher. I don't look at forecasts because the analysts that follow companies, they are always optimistic. You've never found one that's pessimistic. I mean, they just don't. And so in 2008, they said earnings are going to go up 10%, and earnings plummeted. So I don't take the forecast. I look and say, what's the real number? Because if you want to talk about fake news, stock analysts, they're full of it. I mean, they absolutely are. I worked for a couple of investment banks, and I know. Because the first thing, if I was going out on a call to a client, I would check with my analyst and say, hey, do we have a buy rating? Because if he said, no, we got to hold, I was like, I don't really want to go see that client, because they didn't want to give me much business if we didn't have a buy rating. So what happens? Everybody has a buy rating. But when you look here, historically, the number here is about 15. That's about average. You go back to 1980 and say, wow, it was below 10. Wasn't that great? Yes, but inflation and the interest rates were double-digit numbers there. So if you look at the price to earnings ratio, it's really an earnings yield. And what I mean by that is if you're at a PE of 10, you're earning $1 for $10 price of your stock. So you've got about a 10% earnings yield. Well, if I have a PE of 20, I have a 5% earnings yield. Well, if my interest rates on bonds were double digits, I have to have a really high earnings yield to compete with bonds. So now with very low interest rates, I would think you would have above average. But the question is going to be what's sustainable here from that standpoint. And I think when we look at this, the earnings numbers that are coming out now are fairly good. Apple missed some numbers. Interesting, AMD, which had missed some numbers, came out yesterday with better numbers than expected, even though they were missed numbers. They were up, what, 18% today? Yeah, I mean, it was ridiculous. But you are seeing guidance, but it's not going to be 23%, because 23% was the earnings last year. Over half of that was the tax cut. You're not going to get a new tax cut every year. And so this year, probably 7 to 10%. And it may be on the low side, especially the first quarter. Because we are hearing, and we're hearing more and more of the tariffs having being real problem. When Apple said, they missed their numbers, they said our iPhone sales were great in the U.S., great in Europe, great in Japan, but the entire miss was out of the China region. So same way, Caterpillar came out with their numbers. Good numbers all around except out of China. So you're seeing that the tariffs are having an impact. And if that blows into a full trade war, the IMF, the International Monetary Fund, has estimated that it will knock 1 to 1.5% off global GDP. That could push Europe into recession, might even push us into recession. So there are some clouds on the horizon. You look and say, well, not everything's great, and it's not. I mean, and it's hard on the tariffs. It's hard to forecast that. At least on what the Federal Reserve is going to do. You can look in future rates in the futures markets. You can look at bond prices and yields going out and extrapolate what people are thinking. On trade, you really can't. I mean, trade's more dependent upon what tweet comes out tomorrow morning at 6 a.m. And that's the uncertainty that the market doesn't like. Now, why do I have an elephant up here? I don't know. Why do I have an elephant? So, as we've gone through these other illusions, you look and just like I showed here and said, the PEs, are they good or are they bad? Oh, they're 20% cheaper than last year, but is that good or bad? Is that cheap or not? You look at the elephant, you say, it's just an elephant. Start counting the legs. And you start looking at, whoa, hold it. Where are the legs? Which are the legs? So same thing. People can look at something and it appears one way, and when you first look, you may think, and you see this all the time on earnings. Somebody comes out with earnings, it appears they beat, and they rally, and then the next morning, all the rally's gone, and they open up minus 5%. Because people looked and focused on, oh, but their outlook wasn't quite as good, or this segment that had been growing really fast, it slowed down significantly. And so all the time, when you look at the data and look at the news, you have to not just say, is it good or bad, because to some people it will be good, to some other people it will be bad. And this is corporate profits, and what I want you to see here, if you look, dramatic plunge in 2008 and 9, and then it's rebounded. We're at all-time highs. Now, one of the things that you need to understand is a lot of companies have played a lot of financial games, and what I mean by that is if I'm a company and my earnings, my total earnings, if you recall, most of the time when they say, the earnings of Apple came out, they don't say, oh, they were $15 billion. They say they were, X dollars per share. Well, that's just, I take all my earnings and I divide it by the number of shares. Well, a good way to manipulate stuff, I go out, I borrow several $1 billion, I buy a lot of the denominator of that number, my shares, number of shares goes down, and voila, I increase my earnings per share.
Oh, come on.
Yeah, you wouldn't think anybody would ever do that. I will tell you, one of the problems that I see with low interest rates that have been kept artificially low is anytime you manipulate a market, there's a cost to that. And the central banks around the world seem to think there's no cost. I mean, they printed in the realm of 13, 14 trillion dollars in euro and yen and dollars over the last 8 years, and they act like there's, it's just free money, so we printed it, it's not a big deal. If that were truly the case, counterfeiting would not be illegal, because having more money out there that I make on my printer out of thin air shouldn't impact it, but it does. And so when I look at the earnings per share and all the billions and trillions of dollars that have been borrowed to buy back stock to make those earnings per share go up, it will distort. And I'll tell you one of the places it'll distort. And if any of you guys have ever worked in corporate America, you probably will recognize this. I'm the CFO, and you come and you're a mining company, and the head of mining comes and says, "Hey, I want to open a new mine in Timbuktu, and it's going to cost $1 billion." And I say, "Okay, well, give me the numbers," and he says, "Here's what it's going to be. Here's what we're going to produce." And then I look and I say, well, okay, I've got to go out and borrow some of the money. I've got to use cash that we have. And if I used to borrow money at 8 or 9%, now I'm borrowing at 4 or 5. All of a sudden, what's going to occur is when I look at, is that a profitable investment? Voila, at 4%, it's profitable investment. So I say, sure, here's your $1 billion, go build a plant. Where I wouldn't have done that 4 years before because I had to borrow money at 9% or 8%. So what happens is I go spend $1 billion on that mine, and if every other mining company does the exact same thing, all of a sudden we've got too many mines. But I'm not going to shut it down until the prices fall below my cost of producing it. It goes in economics, it's when the marginal revenue falls below marginal price. And basically I don't even count my $1 billion, and so I'm not going to shut it down. I'm going to keep doing it, and you get oversupply. And that's one of the things people have said. If the economy is doing so well, why have commodities not gone up? Because of that very issue. And it's not just a gold mine, it's fracking in North Dakota, it's fracking in the Permian Basin. If I can borrow money cheaply, then I'm going to do that until my marginal cost gets above my marginal revenue. And so it gets a misallocation of resources, and there's a cost to that long term. Yes.
What does that have to do with corporate profits?
Probably nothing, no. No, what I was getting at is you know, a lot of companies have borrowed money to, you know, but this is a real number. I mean, the corporate profits are all-time highs, but if I used earnings per share, it would be way up here. Why? Because the biggest buyer of stocks over the last 10 years has been corporations. One of the reasons that October was such a bloodbath so quickly is because most companies that have stock buyback programs, it's not legally mandated, but it's just more of a compliance issue, they will typically suspend a week or two before earnings come out their purchase, because they don't want to be seen buying their stock a week before they announce great earnings and people like, oh, you got in, you knew that was going to happen. So a lot of them will suspend it and will not start that again for a couple of weeks. And so what happens in October? All the earnings come out, but the stock, you know, dives. The biggest buyer sitting on the sidelines. It's not hard to, you know, to see that would impact it, and it did. Now, the other thing that is of concern going forward is the Fed balance sheet, and they talked about that today. And I know you guys probably don't care about the Fed balance sheet, but it does impact your portfolios. And what I mean by that is back in 2008, and really for a decade before, this level, which is below $1 trillion, was what they had. They only had treasury bills, and they only used it to control what the short-term rates were. But when the Great Recession occurred, all of a sudden they stepped up, started printing money, and started buying bonds and mortgage-backed securities. And it went up and up and up, and a couple of years ago, they stopped. And when they stopped, they said, yes, we're not going to buy any more bonds, we're not going to print any more money, but one of the things we are going to do is when a bond matures or mortgage-backed securities pay principal, we're going to take that money on a monthly basis, reinvest it, so that we keep that $4.5 trillion on our balance sheet. Well, they did that to push this money out into the economy. And what it tended to do is increase the value of risk assets, predominantly which were real estate. And now what occurred starting about a little bit more than a year ago is they said, you know, we're going to start, when those mature, we're going to let them roll off our balance sheet, and we're not going to reinvest. And so you went from about 4.5 trillion to 4 trillion. Well, if you look and the Fed says, oh, that has no real impact on the economy. Well, to me, you can't say, I printed all this money to push risk assets up, and by pushing it into the economy and the markets, it pushed them up, but when I pull it out, there's going to be no impact. That, I think, is fake news. Because you know, you can't have it both ways, and we saw that it did work. Now, what they're doing, and they started out slow. They started out in the first quarter, it was 10 billion a month that they were taking out, 20 billion, 30 billion, 40 billion, now it's 50 billion. And now 50 billion a month is rolling off the balance sheet and it being effectively sucked out of the economy. That's $600 billion a year. Now, what they said today, they didn't say it outright, but they alluded to the fact that it may be, because people were saying, are you going to take it all the way back down here to 1 trillion? That's a lot of money pulled out of it. They started talking about the increased needs of reserves of the banks and stuff. And what they're talking about is there's a couple of articles that have come out by economists saying if they moved it down to about $3.5 trillion, that should be sufficient. And I think what they're indicating in the market, that yes, probably by the end of the year they're going to stop the roll off of that, which will help will help the markets. Because if you're sucking money out, if there's more people pulling money out, like the central banks, it's going to hurt the markets. It won't hurt the economy a lot, but it will hurt the markets. So that's probably a bigger issue than them raising rates. You see the rates going up, you won't see this, but you will see the impact in the market, both the stock market and the real estate market. And I think you've seen it. I mean, you're seeing real estate that was going up 3 to 5% a year, this, especially in places like New York, that's actually leveled off and gone down some. Now, what does that have to do with this? Sort of the same thing. if you focus on this, it nearly looks like it's moving. Optical illusions are always fascinate me. But it's the same thing. People will look at that and say, oh, don't worry about it. You know, the Fed says that's not a problem. Other people will look and say, hey, it looks like it's moving. So, things to watch for this year. Can you imagine any two people that look less happy and less comfortable shaking hands? You know, yes, we're friends. Yes, we're going to work this out. Not very happy. That's going to be a big issue. Basically the truce that they put in place, March 1st, if they don't get something in place, tariffs go up a bunch. I suspect they may, kick the can down the road, because you'll hear a tweet or one of the administration officials saying, "Oh yeah, we're really close," and then you'll have somebody come out and say, "Oh, we're so far away, I don't know why we're even meeting." So I don't know, how it's going to turn out. And a lot of people say, "Well, why is it? What are we trying to accomplish there?" Well, I'll tell you in a nutshell, there are some things of the differences in trade barriers as far as tariffs, but there's always differences. For example, you now see lots of trucks, pickups and stuff from Japan, right? You see Toyotas, you see Honda, you see all of those. How many European pickups have you seen in the U.S.? The problem that you've got is if a Chinese company says, I want to come to the U.S. and set up operations, they can come over, they set up a subsidiary, they bring their money, they buy, they employ, all that stuff. We don't have a problem with it. If a U.S. company or nearly any other developed country goes to China, one of the things they say, oh, you want to be here and I have operations? Well, you got to have a local partner. And oh, by the way, whatever technology you have to share with that local partner. Well, it's not hard to see that it would be easy for that local partner to just steal that technology and use it other places, especially in the military complex. And, the problem is we're bad negotiators. In 2003, when China was trying to get into the World Trade Organization, which makes trading and export dramatically, it's a uniform set of rules that everybody plays by. That's when we had the leverage to say, no, you make those changes or you don't get in. And we didn't. They said, oh, it's going to take us time to reform and make those changes. And we said, okay, we'll let you in, as long as you agree to that. Well, we saw how agreements in the 1990s with North Korea worked out. It's not just tariffs, it's having the same access to your market as we allow for our market. And intellectual property, the trademarks, the patents, those things, which are very valuable and we're good at. We're good at innovation. And basically we're saying, we're tired of you stealing that. So that's one of the big concerns we have, that spins out of control. Corporate profits, like I said, I think you're going to have decent corporate profits. You'll see some headlines saying, oh, they've dropped from 20-some-odd% to less than 10%. But half of that was corporate taxes dropping. So I haven't heard anything in the announcements and the guidance that have come out, and there's been a lot of them the last week and a half that scares me yet. Federal Reserve continues to be an issue, if they follow like they were talking today, I think there'll be less of an issue. But I don't know if they just said what they knew the market wanted to hear. Opportunities where we see, and I'll show you a couple of things we're looking at. So this is S&P versus emerging markets. And this is emerging markets, it's sort of gold color here, it looked orange before. This is blue. And this is from 2002 to 2008. You look and say emerging markets were up 361%. The S&P was up 42. Well, you just put me all in that. I mean, why would I be in the S&P? That was, six years that were great. Fast forward, this is the same, but it's from 2010 to present. 2010 to present, all of a sudden the S&P is up 171 and emerging markets are up 25. And you say, wow, that's not real fun. But one of the things we're starting to see, emerging markets, the PE, as I told you, for the S&P is 17 to 19. In emerging markets, it's 10 to 12. Now, there's always going to be a discount there because they don't have the same regulatory stuff, but they're growing faster than we are. The other thing that's kind of interesting is right here, if you see how the S&P dropped dramatically, you didn't see as much of a dramatic drop here in the emerging markets, which indicates people are more comfortable, more money's flowing into the emerging markets than in the U.S., which we haven't seen. We saw in 2017, last year. In fact, if I would have showed you one of the other charts, emerging markets were down about 15% last year. One time they were down over 25%. So you look at that and you say, that doesn't look good, but this looks a lot better than that. And so there may be some, and you'll see in the rotation strategy, we actually rotated into emerging market bonds and emerging market stocks just today or yesterday? Yesterday. The other thing is on the total return, on the low risk part of the portfolio, one of the things that we've had is this is one of the funds that we're in. It's called Alpha Centric, IOFIX is the thing, and it buys non-government guaranteed mortgages. And you say, well, why would I want that? I mean, I think I'd want government guaranteed. What they invest in is ones that were originated from 2003 to 2006. And you say, well, why that? Well, if you've been paying on your mortgage since 2003 to 2006, they started out as basically the bad subprime mortgages, but if you're still left in that pool, then you paid down a significant amount. Most of those started where the loan and the house value were the same, so 100% loan to value. Most of those today, if you've been paying, are down to about 50 to 60%. And if you've been paying all that time, you're a good credit risk. You might not have been when you took it out, but you demonstrated you paid for a long time. And that's why you're seeing, and it's also floating rate, meaning that if interest rates go up, short-term rates go up, these mortgage rates will go up. This is the aggregate bond index, which is flat in last year, just slightly down, and that was up about 4 or 5, and it's yielding about 5%. We like that because it takes some of the interest rate risk out and very little credit risk. The other side that you're seeing, and this is high yield or junk bonds in the total return area, and this is, they call it the spread, and the spread just means, if treasuries are 2.5%, and this is 4%, it means the yield on these bonds are 6.5%. It's just how much above the treasury rate are these bonds. And here, basically, we were between 3.5 and 4, and then it jumped up at the end of last year. Well, when it jumps up, it means the yield goes up and the price goes down, which is a great time to buy. Most of last year, we were out of high yield bonds. And we got in a couple of weeks ago, and I don't know, it's probably up 1% since then in 2 weeks. And the yield on that now is between 6.5 and 7%, where 3 years ago the yield on those things were 4 to 5. So we think there's an opportunity there also on the fixed income side, but our models will tell us whether to stay in or not. So I guess I look at it. And I look and say, I'm sort of cautiously optimistic. When you look at the different strategies, like I said, total return is in the mortgage-backed securities that are floating rate, it's in high yield, and it's also in high yield municipals. And even in your IRAs, and you'll say, why do I want a high yield municipal in the IRAs? Because they're doing very well, and the yield is above 4%. So this is fully invested. Rotation has emerging markets, emerging market bonds, gold, real estate, and a little bit of short-term bonds. If you look, on the growth side, we've got a little bit that's in short-term bonds. Most of that's invested both in the large cap U.S. The value stock has done quite well since the first of the year as far as relative to the S&P. The 10 stock and the 5 stock, which are the ones that generate the highest returns when things are good. Today we went back in. We were out of that for a couple of weeks. Went back in half 2 weeks ago, and then fully back in today. the 5-stock momentum, it's above what the S&P is doing this year comfortably, but we still have about 35% that's in short-term bonds there. That's going to move in tomorrow. If you remember, Thursdays is when we run the 5-stock. And our model triggered to get back in today. So we did it on the 10. We'll do it but it's above the S&P, even being 35% in short-term bonds since the first of the year. So, we're cautious because there's a lot of moving parts out there, but I'm still optimistic. I mean, when I look at all of this, I still look and say, overall, the data, the concern for the Fed is the sentiment numbers. And what I mean by the sentiment numbers is people's expectations. The hard numbers of how, what was sales, what was, employment, all of those numbers are very positive. But when you look at the sentiment numbers of what do you think about the future and those things, those have gone down. But they typically do when you have volatility in the market and uncertainty like we've had from a political standpoint. I mean, shutting down part of the government doesn't instill a lot of confidence. I mean, that's just what it is. And so if you ask me, 3 months ago or 6 months ago versus today, I'm probably going to say, well, I'm less certain today because, in 2 weeks you may see the government shut down again. I think from our standpoint, we're cautiously optimistic. I don't think it's we're out of the woods completely because there's a lot of things there. But I do think the base fundamentals, and I will tell you, a lot of people you're seeing it already of people saying, hey, this is going to be just like 2008. It's going to tank. Most of the time when the market has really gone down, and what I mean really gone down, you say, what do you mean? It went down 15, 20%. The 30 to 50 or 60% like we saw in 2000 and 2002 and 2008 and 9, those have always occurred along with a recession. And when you look at all-time lows of unemployment, all-time highs in consumer income and consumer spending and GDP, typically in the next 6 to 12 months, unless there's an external shock, typically that doesn't coincide with a recession. Now, a year or two down the road, different story. But over the next 12 months, I don't see any normal economic indicators that would say we've got a real problem. Questions? Other than that dessert looks really good. Yes, Joan.
I'd like to understand how the model changes as all of these inputs go up.
Well, and let me tell you one of the things that we're working on. The total return income. We've done that for nearly 10 years. It works like it's supposed to. I mean, you saw last year there were times that it was a huge percentage of it was a short-term bond. It works like it's supposed to. The 5 and 10 stock strategies and the rotation work as it's supposed to. We're still looking at a couple of changes potentially there. The 5 and 10 stock strategies, though, we've demonstrated we've used those for a long time, especially the 5 stocks the last 7.5 years. It's made a lot of money. We're trying to look at the risk management piece of that because, even though last year it outperformed the S&P, everybody that was in it knows that we gave up huge gains. And at the first of the year, if I would have told you, yeah, we're going to beat the S&P by 4 to 6% on that, you'd say, okay, that's good. But nobody was happy, including, because we're invested exactly like you're invested. Nobody was happy, to give up the gains that we gave up in the fourth quarter. And so we're working on some of those as far as adjusting those models and actually looking at a couple of interesting things to reduce the risk once we've got some gains there. So we adjust there, and I will tell you there's another model that we're looking at that's completely something different than we've looked at. All of the stuff all of our models are based on price and volume. Stock goes up, the volume's high, the stock goes down, all that. The one we're looking at is looking at fundamental data. And what I mean by that is looking at the earnings acceleration from a quarter this year and a quarter last year, and it doesn't look at the price at all. And it comes from, I was at a conference and there was 2 professors from Tulane. and it's interesting, one professor from China, one professor from India, and had a paper that they looked at this because it's completely unique. I'd never seen a paper like that. And of course, one of the things, most of our strategies come from academic papers, but a lot of the academics, they're looking at the theory, not can it actually be put in place. And when we first looked at it, what we found is most of the gains that they were looking at came from microcap stocks. That if I want to buy 100,000 shares of it, I can't. And so part of it, but then we started looking at using that in a sort of a different way and came up with, there's some stuff that works pretty well. And what makes me excited about it is when I look at those stocks versus everything else we're holding, hardly no overlap, which tells me we can get some diversification. So if
So
one...
that would be a new category.
It would be, yes. And typically the way we do it is we will run that model for 6 to 12 months in one of our own accounts to make sure that we can execute and everything like that. But we're always looking, but the risk model is the one that we're putting the most time and effort in. It was interesting, we had a consultant down from Toronto the first week of this year. And in Toronto, this time of year, in fact, I talked to him yesterday. He said it was 6 foot of snow in his driveway on the side. But he comes down and he said it never gets above freezing this time of year. And the second day he shows up, he's got this Hawaiian shirt, he's got flip-flops on. And I said, that tells you you're from not around here, because everybody here is wearing a jacket because it's only going to be 60 or 55 or 60, and he's thinking this is summertime. But we are looking at some of those things because the more diversification of different strategies that look, because I will tell you, if you look, the 10 stock and the 5 stock are both momentum type strategies. Different ways to measure it in different stocks, but it is the same type strategy. And so if I can get one that looks at a different set of companies, then I get more diversification. Other questions? Good food? Did it put you to sleep? Well, thank you for coming. We're going to be around, and our plan is to have one of these in the spring and one of them in the fall. And it's interesting because we, great turnout response here. I was up in Salt Lake last week, same thing up there. And maybe it just has to do with finishing up a really volatile year. Everybody's, I want to hear. But we'll be talking about sort of the same stuff of what are we looking at, what are the potential risks, what are the obstacles and the opportunities. But we appreciate the trust you've placed in us. We take it very personally. And if you feel free when the market drops or when the market's up. Just feel free to give me a call or any of us. We're there to, you're not bothering us. We're there to answer questions. And most of the time we like to talk about the markets. I know you can't tell that from what I've talked about tonight, but we do like that. I mean, we live this stuff. And when you get the monthly newsletter or any emails that we send out, if you have questions, just feel free to call us and ask them. Instead of looking and saying we're going to do specific countries, we've looked at, we may revisit some rotation strategies that will look at specific countries. But the problem with that is, like the Chinese markets, this year there were several of those that were down over 30%. In fact, and it was near the end of December, I didn't see the final numbers, but probably right before Christmas, I saw a stat that said over 50% of the world indices, all around the world, were down more than 20% at that point. And one of the things that I think you're seeing is the printing of money. A lot of that money has flowed into the U.S. Because if you look at China, China is growing tremendously, But if you get on the wrong side of the government there, you just disappear. I mean, CEO of Antbank, huge insurance company there, all of a sudden he's arrested and you don't hear from him again. So if I'm over there and I'm making lots of money, what am I doing? I'm trying to get it out. I mean, the market in Vancouver has been just taken over by Chinese money, and people are not even living in the houses. They're just trying to get it out of China so that they have a place to go. My daughter lives in Alhambra in Los Angeles, and that has become a place for Chinese people. I mean, you go to regular U.S. banks there, and they will have stuff in Chinese. It's because people are trying to get out. Same way out of Russia. You're seeing, any money coming out of the Middle East. I mean, you saw what happened to Saudi Arabia last year. I'm a billionaire, and all of a sudden I'm a billionaire in Ritz-Carlton Hotel, and until I sign over a bunch of my money, I'm not getting out. And that's exactly what occurred. So we've become the safe haven, and as a result, I think that's hurt the foreign markets. Now that may change as things stabilize around the world. I think more people will be comfortable, investing overseas. But it's not been the place to be over the last decade. So, yes,
I
Joe.
don't know whether this is a different question, but we have grandchildren that are growing up and they're just taking their first jobs now.
Yep.
And it's not the same as when we took our first jobs, when the economy was booming and everything was fine and you could always get a job.
Yep.
And the money went up at 10-12% of your savings. What should we tell them to do at this point?
Keep
I
working.
mean, they have jobs, but they don't have the same kind of jobs as necessarily all of them as well as good.
Right. Yep. Well, what I tell my my kids and my grandkid, in fact my granddaughter, that she's she's a junior, I guess, and one of the things she finally got a job this last year, and we went to the movies, and and I bought the tickets, and she goes, I think I want some popcorn. And I said, well, go get you some popcorn. She comes back and she goes, do you know how much they charge for a hot dog? And it's like, yeah, you didn't ask that when I was paying for it. So what I tell them is I say, you're going to have to work hard, and you're going to have to save a lot because you're not going to have a pension. That's those days are gone unless you're working for the government, and even the government pensions are going to be dramatically less because that is one of the time bombs that's going to blow up on us is the government pensions, and you're seeing it from Arizona. I mean, you go to you look at some of the stuff in Illinois, it's a disaster. I mean, so I say you got to save more. You still need to invest, just like you invested, but you may, you're probably not going to retire at 62. You're probably but you're also probably going to live to 90 or 100. So you're still probably going to have 25 or 30 years. Yeah. So I would tell them the same thing. You need to get more education. I think today. You probably need an advanced degree, a master's or a PhD in whatever you're doing, or advanced training, because I think what is occurring now is if I've got a college degree, it's sort of like used to be a high school degree. I think I need something more than that. The problem now is that these students going and getting a degree to be a teacher at an Ivy League school and coming out with $300,000 or $400,000 worth of debt. I mean, I think you have to be smart on that. It's not just, oh, let me go and whatever it is, I can borrow the money. Yes, you can borrow the money, but you got to pay it back.
You got to pick the right thing to study.
Exactly. And I want people that want to be teachers to be teachers, but they can't come out of school with $250,000 worth of debt. They come out and they look and say, I'm going to have less income than probably relative to what it was 30 or 40 years ago, but I'll have a lifestyle and I'll be doing what I like to do. So.
Which we had that opportunity to do without having debt.
Yep.
Because schools didn't cost that much.
Yep. Well, my undergrad was at Texas Tech, so Mahomes from Kansas City, he's my hero because he was there, exactly. But I had a scholarship, and it was $500 a semester. And this was late 70s, early 80s, and that paid all my tuition. And I got a little part of that I could use on books. The other problem is books. I mean, books cost more than tuition used to. I mean, it's ridiculous.
They're paperback.
Yeah, exactly. Yep. So, other questions? Well, thanks for coming, and like I said, we're going to be around for a while, and we're always around for you guys. Okay?